Good morning and welcome to our first webinar of 2021. I'm Angela Strangman and I lead the marketing team here at Trustpoint. It's great to see so many of you here today and I appreciate you taking the time to join us. We appreciate everyone who submitted questions prior to today's event and we have worked those into the presentation today. We will also have time at the end for additional questions. So if anytime during the presentation you would like to submit a question, please use the Q&A feature on your Zoom session to get those to the presenters. I wanted to just take a moment to talk about some of our recent milestones and news here at Trustpoint. In 2020, we continued to grow and in fact are now $6 billion in assets under management. This is because of you, our clients and friends, as the majority of our new business still comes from referrals. Thank you for the business and the trust you continue to place in us each and every day. Another reason for our success is our great team who continue to deliver exceptional service despite the challenges that we saw last year. Our 85 employees in our 3 locations serve clients across the US. And while you may know your relationship manager or your portfolio manager on your account, we want you to also know that they are backed by a team of resources here who specialize in financial topics to handle even the most unique situations for our clients. The ones listed on your screen are just a sampling of the expertise, and having them all under one roof, all working for our clients, is quite rare. While we have our own attorneys and CPAs on staff as well, we also work with a large network of firms to collaborate on behalf of our clients. You can see that we have won the best places to work, and actually we've won it 3 years in a row. And as research would tell you, happy employees mean happy clients. So we're pretty proud of that award. Most of you know that Trustpoint offers trust administration, including corporate trustee services, wealth management, including investment management, tax strategies, estate and financial planning. But we also have over 200 retirement plans with thousands of participants we service each year. I'm also excited to announce that later this year, we will be able to help a much larger client base with financial planning, financial education, and investing through an online platform that will offer many self-service tools, while also allowing for the option to reach out to someone for additional guidance. Stay tuned for more on that. 2020 allowed us, as many others, the opportunity to learn about Zoom. And as you can see from the numbers, we took full advantage of it, and it's probably a tool that will remain well into the future. We also recognized the impact of technology in our business model and the adaptability of our clients in using new technology. As such, we spent a great deal of time researching the user experience and platforms that will offer Trustpoint clients an enhanced online experience. Now, rest assured, we will still offer face-to-face or Zoom to Zoom, as it has to be for right now, the personalized experiences that you've come to expect from us. This is only meant to provide you additional options in accessing your account. More on this will also be communicated in the coming months. Now, in the last couple of sections, I did mention communication. So this is my plug to just say, make sure that you are on our email list or that you are following us on Facebook and or LinkedIn. Now, I'm going to ask our presenters today to come on the screen. In honor of Groundhog's Day and our friend Phil out in Pennsylvania, who did predict, by the way, we have 6 more weeks of winter, I will be joined by Trustpoint's own prognosticators of sorts, Randy Van Rooyen and Jan Arsenal. However, I guarantee they use more research and proven principles to bring you their investment insights. These are the topics that we plan to cover today. It will take about 45 minutes. And like I mentioned, we will have time at the end where we will have opportunity to answer some questions that have come in from our audience. So with that, I'm going to turn it over to Jan.
Thank you, Angie, and welcome everyone. 2020 has been, quite a year to say the least. And in our world, the investment world, it was no different. And I think for me, 2020 will be remembered as the year where we rewrote the playbook on how and also by how much governments and central banks can influence economies and markets. I'll spend more time on this in a minute, but let's start our conversation today with this first chart. It shows the gross domestic product for the US economy, the total value of goods and services produced by our economy. No surprise, the decline in economic activity we experienced in the early part of 2020 was pretty big. The biggest decline on record, in fact. Lockdowns and stay-at-home orders were obviously the cause. From February to April of 2020, the unemployment rate in the US jumped from 3.5% to 14.7%, something we had never seen before over such a short period of time. So the economy went into full paralysis, but only for a short period of time. I think humans have this incredible ability to adjust and adapt to new situations or new environments, and we did just that. We adjusted, we adapted the best we could. We found new creative ways to work, to shop, to entertain ourselves. And along the way, we got some help as well. We got help from the US government and the Federal Reserve. And as a result, in the third quarter and the fourth quarter of last year, the economy bounced back really strongly. You can see that equity markets were caught by surprise in the early part of last year. The unexpected impact of the global pandemic on economic activity led to a bear market in equities. As the chart shows, in a matter of only 5 weeks, the S&P 500 declined by almost 34%, a very quick decline by historical standards, but not as steep as what we had experienced during the 07-09 recession or the 2000-2002 recession. The interesting part is that it took only 128 days for the S&P 500 to get back to break even. And as a result of that strong bounce, the 2020 bear market was the shortest on record. What the market normally discounts over the course of quarters during recessionary periods, it did in a matter of weeks, on the way down and on the way back up. And as you all know, markets didn't stop there. In fact, for the full year, the full calendar year 2020, the S&P 500 was up 16.3%. Truly amazing. At the beginning of the presentation, I mentioned that 2020 will be remembered, for me anyway, as the year we rewrote the playbook on the role and influence governments and central banks can have on economies and markets. So let's talk about governments first. Without the help of governments, 2020 could have been worse. A lot worse, in fact. But because governments around the world stepped in quickly and aggressively, the worst case scenario was avoided. So we titled this slide, "Don't Fight Governments." And what it shows is fiscal support in 2020 as a percentage of gross domestic product. That would be the light blue bars to the right. And it compares last year's response from governments to the 2009 response. In the US in 2020, we spent 14% of national GDP to support the economy. And that number doesn't take into account the $1.9 trillion package that is currently on the table from the Biden administration as additional stimulus, which would bring that 14% number to about 25%. So about 4 times what we spent during the last recession. So the bottom line here is quite simple. Governments around the world went all in during the pandemic. And with interest rates at record lows, there was and still is today an incentive to go big on government spending. In fact, recently confirmed, Treasury Secretary Janet Yellen said just a few weeks ago, and I quote, the world has changed. In a very low interest rate environment like we're in now, what we're seeing is that even though the amount of debt relative to the economy has gone up, the interest burden has not. End of quote. I'll talk more about this at the end of the presentation, as I know many of our clients wonder if we can continue down that path, the path of growing federal debt and deficit. So more on that in a second. The reality is that governments alone could not have engineered the fast recovery in economies and markets alone. They needed help. They needed help from central banks, and they sure got it. Shown here is a chart of bond buying programs from central banks around the world. What it shows is the aggregate value of all government bonds held by central banks around the world, about $13.3 trillion with a T, a big T. These are bonds that central banks have purchased in the open market with newly created money to facilitate the issuance of government debt at low yields. So here's how it works. Governments issue bonds to raise money. Central banks step in and buy the bonds to ensure that the cost of financing is low. Governments then take the money raised and distribute it to people and businesses. When combining monetary and fiscal stimulus, the response has been, in fact, much, much bigger in 2020 than it was during the Great Recession of 2007, 2009. So government and central banks working together have been the main catalyst behind this fast recovery in economies and markets. The response from governments and central bank was not only big, but it was fast and it was open-ended, meaning that if more was needed, markets could reasonably expect that more would be provided. And guess what? It worked, and it worked really well. So I titled the previous slide, Don't Fight Governments. I titled this one, Don't Fight Central Banks. What used to take 10 years to develop, we were able to develop in 1 year. So vaccines are now being administered globally, and we think that by the summer, we will get herd immunity in the US. So we know that vaccination will boost mobility, and that is very important because what we've observed is that weak household spending is not the result of income shortfalls, but a general unwillingness or inability to engage with in-person economic transactions because of health risk associated with COVID. It is estimated, and this is just an estimate, that more than 20% of the population is already immune. We have about 25 million reported cases so far in the US, which equates to about 7.5% of the population. But it's been estimated that another 40 to 50 million or so have had the virus already, but were never reported, many because they were asymptomatic. And that explains why experts believe that we have more than 20% of the population already immune to it. And with vaccination ramping up, it's just a matter of time before we get to herd immunity. Okay, so I'll now turn it over to you, Randy, to cover the second portion of our presentation, which we title Foretelling Equity Charts.
Thank you, Jan. Yes, there's no doubt very few could have dreamed up a year like 2020. I don't recall a year when the overriding sentiment from so many people was just relief to bid a year farewell. Considering all the investors had to endure, equity markets still found a way to finish 2020 at all-time highs. Needless to say, markets remain unpredictable on many levels. In fact, we're going to start this section today with a topic that we wouldn't have planned to talk about just a week or so ago, and that is, of course, GameStop. Of all the questions that we received, and thank you for sending those in, I would say about half of those were related to what's been going on in the last few days and weeks with with companies like GameStop. So we'll spend a little time helping explain and give our views on the latest events. So GameStop is a publicly traded video game retailer. Like many other retailers, has struggled for years. It has closed hundreds of stores over the last years and didn't make any profits last year or the year before that. In fact, in the 2 years combined, the company lost about $1 billion. Yet its stock price went from about $3, as you can see from the chart here, a year ago, to over 300, and actually I think touched 400 on a given day in recent weeks. GameStop is not the only stock seeing astronomically moves higher. Express, Cost Corp, AMC Entertainment, Bed Bath & Beyond. What did all these stocks have in common prior to trading hundreds and even thousands % higher over the last couple of weeks? They all were heavily shorted shorted by hedge funds. Short selling is an investment or trading strategy that speculates on the decline in a stock. Simply, you're betting against the stock. While this commonality of these heavily shorted stocks didn't ignite the initial rally in these stocks, it did exaggerate the gains more recently. And I think it's important to understand the structure of being long a company or buying a company and then shorting. When we're long a company, we know that our worst case scenario is the company goes to zero. So it's capped at a zero loss or bottom at a zero loss. With short selling, your worst case scenario actually is unlimited. As the stock rise, you continue to lose their value of your short. So where did this all start? Essentially, an army of at-home retail investors came together on Reddit, a network of communities based on people's interests, to pursue buying companies like GameStop. Rookie investors encouraged each other to pile into GameStop shares and call options. As prices started to move higher, the hedge funds who were short the stock started to cover, which means they had to buy back the shares that they borrowed. This created a short squeeze, which is another commonly used term in the industry, but certainly getting a lot more press as of late, which consequently propelled the stock even higher as more and more hedge funds started covering their shorts by buying stock. The GameStop thing is a reminder that investing is not just about the study of economics and finance. It's the study of how people behave with money. And what we have seen in the recent days is nothing short than incredible. The power of social media as a mobilizing and influencing people has been evident here and should not be taken lightly. Something we think the authorities and regulators will take a closer look at in the weeks ahead. As exciting and impressive and entertaining this is, we certainly wouldn't encourage clients to participate in the speculative behavior, but rather stay focused on long-term diversified portfolios. Before long, we would expect the regulators to take a very close look at this. Market undercurrents like this typically don't end pretty. You don't want to be the one left holding the bag. And if today is any example, I believe GameStop closed yesterday about $225. Actually, this morning traded about as low as $80 and then was halted trading because of volatility. What effects has this had on broader markets? The speculation we just described has been isolated to very few group of stocks, while we believe the broader markets continue to trade off longer-term economic factors and fundamentals. Does this have a potential to become a bigger issue in the stock market? It's possible. It's a bit too early to tell. As we've been saying, the movie isn't over, so to speak. We are closely monitoring the situation, but at this point, we remain unalarmed. So along with GameStop questions, another question we often get from clients is regarding to equity valuations, or how expensive the stock market seems. When we talk about valuations, it speaks to how much investors are paying for stocks considering expected earnings. It's true equity valuations are high, which you can see from this chart below. The chart illustrates over time PE ratios, or price to earnings ratios, which is often utilized as a measurement of valuation in the stock market. On the right-hand side, it shows today stock valuations are elevated to a level not often seen. In fact, we are at the 95th percentile for valuations historically. Said another way, markets have only been more expensive 5% of the time. As investors, this can be concerning. There's two ways to remedy this situation. First, corporations' earnings can catch up and rise, which would decrease valuations, or stock prices can fall, and that would also decrease valuations. So let's look at some considerations for today's high valuations. So the first one I want to talk about is just more structural over time, what corporate values are made up of. In the past, companies were much more capital intensive and arguably less efficient. Today, 90% of the S&P 500 value is estimated to be based on intangible assets, things like R&D, software, intellectual property. This makes it hard to make historical comparisons on valuations. Today's companies can do much more with less through productivity and innovations. We believe this partially explains the upward drift in valuations over time. Another consideration is normal. It is normal for valuations to surge in the earlier phase of a recovery. Markets are most often forward-looking. Investors start to anticipate the improvement in earnings before they actually materialize. On the very right-hand side in dark blue, it shows in 2020, the vast majority of equity gains did not come from earnings growth, but rather multiple expansion. Investors willing to pay more today for potential growth in earnings in the future. We also saw the same was true in the Great Recession back in 2009. We expect that earnings will come through in 2021 and 2022, making valuations that today look expensive more reasonable. And then lastly, low yields support high valuations. As Fed Chairman Powell himself alluded to in a December press conference briefing when commenting on the soaring US stocks and their valuations, and I quote, "Admittedly, PE ratios are high, but that's maybe not as relevant in a world where we think the 10-year Treasury is going to be lower than it has been historically from a return perspective." You can see from this chart that there is a close relationship between stock valuations and interest rate levels. In red, the red trend line represents the 10-year TIPS yield, and the green, the S&P 500 forward PE ratio. Sustained levels of interest rates lower than we've seen in the past in itself is a good reason to own stocks. In fact, relative to bonds, we think that stocks are much more attractive. Over 70% of the S&P 500 companies are paying dividends greater than the 10-year Treasury yield of about 1%. And with stocks, of course, you get the price appreciation potential. With bonds, you collect the coupon, and that's it. At the end of the day, in an environment when interest rates are historically low and expected to remain low for longer, equity valuations can run higher for a period of time to allow earnings to catch up. The more likely scenario is that we will hit bumps in the road along the way, but over the next 6 to 12 months, we still value more upside in equities than bonds. So let's shift gears a little bit and look at 3 considerations for fixed income. Again, 2020 was a unique year in many ways. As it relates to investing and portfolio management, it was specifically a unique year in that not only did equities post strong returns, but fixed income returns were strong as well. However, the strong rally in bonds, really since late 2018, have left bond yields historically low. Again, with the 10-year Treasury near 1%. So let's take a look at 3 considerations in the bond market. Our view is that the Fed will be patient and wait as long as possible before raising rates. Currently, markets expect short-term interest rates to start moving higher in the summer of 2023, as the chart shows below. For the time being, the Fed's strategy is clear and deliberate: to make debt the cheapest it's ever been and to deter saving and encourage investment. And by lowering the return on safe assets, they indirectly increase demand for risky assets, as we've discussed on the previous slide. This is the environment we're in, and we suspect that central banks around the world will continue taking the same approach as well. In fact, real rates are negative in many countries. Until we see higher yields in bond markets, we believe that fixed income outlook will remain challenging. On this illustration shows real yields, which is essentially nominal yields of respective 10-year government bonds minus inflation. They remain negative in many developed countries, so a far underwhelming outlook for the bond market, at least for investment grade bonds. This does force investors to think outside the box and consider non-traditional fixed income investments, which may also carry higher volatility and risk. We believe it's our job at Trustpoint to balance the trade-off between yield and risk in this challenging environment. So now that I've thoroughly bashed the outlook for the bond market in general, it's important to understand that the part bonds play in portfolio management. If you look at investment grade bonds on a standalone basis, you may come to a different conclusion than if you consider the purpose in a diversified portfolio. Given the low yield environment, the question we often are asked is, should I care about owning bonds in my portfolio? We think the quick answer is we think you do. There's still a place for bonds in a portfolio. So let's have a few considerations. First, there are things we can do by utilizing interesting opportunities in some non-traditional segments of the bond market. Also, bonds play an important role in cash flows or needs to meet distributions when funds are needed. Also, when equity markets are in a challenging point. And then lastly, bonds will always give you the I can sleep well at night comfort level. As this chart shows, bonds provide a buffer during difficult times for equity markets. They provide stability in portfolios and prevent investors from making uncalculated emotional decisions during sell-offs in equities. With that, I'm going to turn it back over to Jan to cover a couple more sections. Jan?
Thank you, Randy. So we talked about the economy, we talked about equity markets and fixed income markets. You just heard Randy. Now, next we'll talk about portfolios. So we titled this section here, Two Big Opportunities in 2021, because we were trying to keep the flow going here, the 5, 4, 3, 2, 1 theme of this presentation, but we believe that we have more than 2 opportunities to outperform in 2021. We kept the section to 2 slides, but we have a total of 9 investment ideas to share with you. So let's get started. Before I give you our predictions for 2021, let me first explain our core thesis here. So we're working under the assumption that vaccination continues at least at the current pace, and some additional fiscal stimulus is provided in the world economy, which would lead to above trend economic growth and somewhat stronger inflation in the second half of 2021 and 2022. So based on these assumptions, we expect for interest rates, the short-term interest rates to stay flat. The Fed is committed to keep short-term interest rates low. And as the Fed Chairman Jerome Powell said a few times in the past 6 months or so, the Fed is currently not thinking about raising rates. So I said that right, not thinking about raising rates. That's what the Fed said. We do expect some steepening, however, of the yield curve. So we do expect long-term interest rates to move higher in 2021. And as short-term interest rates stay flat, we would have a steepening of the curve. This has implications mostly on duration decisions within fixed income, but also on sector allocations within equities. We do expect the dollar to continue to weaken in 2021. The dollar is a counter-cyclical currency, so it tends to do relatively poorly in periods of stronger economic growth. And on commodities, partially the result of a weaker dollar, but also the result of a stronger economy, we do expect commodity prices to rise. As Randy alluded to, within fixed income, we favor credit over sovereign bonds. So not all bonds are created equal, and in an environment of stronger economic growth and declining default rates, we believe credit still offers some alpha opportunities for investors over government securities. On stocks over bonds, we prefer stocks. That doesn't mean that we won't experience market corrections, but over a 6 to 12 month window here, we believe that stocks offer better relative valuations, will continue to benefit from continued support from governments and central banks, and an improving economy is also favorable for stocks over bonds. On style, we prefer value over growth within equities. So value sectors like financials, industrials, materials, we believe will do well in 2021 and outperform technology, which is the biggest sector within growth and also a clear winner last year, but probably not in 2021 in our opinion. And of all the value sectors, financials is probably our favorite sector at this point in time. US banks are approximately 3 times more liquid and 3 times better capitalized than they were going into the financial crisis. So they're very well positioned, in our opinion, to benefit from this reflationary environment. And when combined with very attractive valuations, we like the sector a lot. For size, we favor smaller capitalization. And from a regional standpoint, we prefer international developed and emerging market equities over US equities. So just to be clear, US equities still represent the biggest weighting in portfolios, but relative to the global benchmark, we are underweight US equities and overweight international equities for a number of reasons. So again, expectations for better economic growth, prospect for weakness in the US dollar, expected strength, as I mentioned, in the commodity complex, and the more cyclical orientation of international equities is also a positive for the asset class. And if you're a client of Trustpoint, just know that your portfolio is already positioned to take advantage of all the things that I just mentioned here. On the next slide, we're going to talk about value versus growth. So the value versus growth call is an important one, and frankly, we don't think it's a difficult one to make. It doesn't matter how you slice value by regions or sectors or size. Value is very, very cheap, almost as cheap as it was in the late 1990s when the tech and telecom bubble burst. So not only value is cheap, but we think the conditions are in place today for a reversal in the favor of value. So again, a stronger economy, higher interest rate, a steeper yield curve, which will benefit financials, stronger commodity markets. All of those are important catalysts for value-oriented stocks. We also view the current environment as a great opportunity for active managers to build portfolios with risk-return characteristics that are better than passive alternatives. Okay, so we will move on to the last section of the presentation here. We'll talk about the most asked questions. So I alluded to it at the beginning of the presentation when I said many clients are concerned about fiscal debt and deficits. Is the fiscal situation in the US sustainable? First, let me explain the chart you're looking at. The dotted blue line is the US federal debt as a percentage of GDP. So you can see the significant increase in the last 15 years. It is in fact projected to hit World War II peaks by the end of 2021 at over 100% of GDP. Despite that, the cost of financing the debt, the green line, is no greater today than it was 15 years ago. So what's going on here? Now, shouldn't the cost of financing the federal debt go up as essentially leverage goes up? And at over 100% of GDP, what are the long-term implications for a country? So let me try to answer maybe the last question first. We will not default on the debt. I think this is a given. Now, many people believe that we will have to cut government spending, raise taxes, or a combination of both to address the debt level. It is possible, but this approach has been tested in other parts of the world before, and it's very unpopular. In fact, in Europe, in the few years just following the global financial crisis, this was the policy prescription, and it simply didn't work. Fiscal austerity in Europe led to weaker economic growth and a rise in the debt to GDP ratio. In recent years, now there's been a complete, I would say, rethinking amongst governments as to how government debt levels should be addressed. What we are experiencing with now is the exact opposite of what Europe did following the great financial crisis. In order to bring the debt to GDP ratio down, we are increasing, not reducing, increasing government spending and reducing taxes. That was accomplished during the Trump administration. Now, will we get tax increases here during the Biden administration? Probably, but in our opinion, it will be more than offset by additional spending on healthcare, education, clean energy, etc. So any additional tax revenues, if we get any, will not be used to pay down the debt. The goal here is to provide the foundation for a stronger economy so GDP can increase faster than the debt, so that the debt to GDP ratio can actually stabilize, if not decline. Now, central banks also play an important role here in two ways: by allowing inflation to slowly move higher, which boosts nominal GDP, and number two, by keeping the interest rates low enough, in fact, below the nominal growth of the economy. Central banks will help stabilize, if not bring down, the debt to GDP ratio. So some call this MMT, modern monetary theory. This is in our opinion, a very significant regime change. It means that the influence of central banks and governments on the economies and markets will just keep getting bigger. Now, could it lead to some unintended consequences over time? Sure. Higher inflation, a decline in the value of fiat currencies, including the dollar, bubbles, misallocation of capital as businesses that would have otherwise failed are kept afloat. But for the time being, policymakers get comfort in the fact that the approach worked really well in 2020, so they're not ready to let it go. In our opinion, MMT is well and alive and really the new regime for probably years to come here. Okay, so we have received a number of questions. We thank you for your questions. We'll do our best to answer as many as we can, but before we do this, a few of you have asked us to talk about portfolio returns. So Randy, if you could spend maybe a few minutes to talk about that next, that would be fantastic.
All right, thanks, Jan. Yes, we have a bonus section, and I think one of the first questions we received was really was asked that we cover the 2020 returns for our various core investment objectives. So that's what I'm going to do here. It's important to understand that these are returns of our models. There are many factors that could cause a specific account's returns to differ, but large majority of accounts will have very similar returns to these models. What you're looking at here are return periods for the 5 core models. On the top, we have the 1 and 3, and at the bottom, we have the 5-year and 10-year returns. So first of all, taking a look at the upper left at the 1-year returns, as we discussed, both the fixed income and equity markets were strong markets in 2020, and it turned out to be a great year. 4 of the 5 models were in double digits, which was always a good sign. As far as the longer term returns go, the uniqueness in the 3, 5, and 10 is that I rarely have seen the returns to be very similar among those 3 time periods, and also very close in line with long-term averages. It's very rare that we see all 3 in line with that, or even one of them for that matter, because we know that, especially on the equity side, returns don't come uniformly year in and year out. Also, against peer group benchmarks, we're happy to report that we fared well. We were competitive and are currently competitive in all time periods. You can see in the upper left and upper right on the short-term basis, strong comparisons there, and then even more so on the 5-year and the 10-year. Looking back at 2020, you can honestly say that we're pleased the way how we managed our strategy, especially after the market bottom in the first quarter, navigating through the pandemic, adding to areas in the market that were being ignored and undervalued. And this was a very important part of how the year ended up for us, because we haven't talked about it, but it was in early November after the election, and then also along with the announcements of the availability of vaccines, the equity markets not only had an impressive run up through even this last month, they also experienced a market rotation, meaning that started to focus on other sectors, other areas of the market compared to what was doing well prior to that time period. And specifically things like small caps. So a focus on economies opening up. So small US companies, value companies, as Jan pointed out before, which would be financials, high dividend paying stocks, cyclicals, all did well in the last several months compared to before. It was really large mega cap tech companies that led the way by far. So with that, I'm going to stop and turn it back over to Angie to start with some questions.
All right, thank you, Randy and Jan, for all that valuable information. We do have some questions that have come in. This one maybe we'll start with Jan. Jan, do you want to comment on 50 or 100-year bonds and what risks they have long term?
Obviously, the longer the maturity of a bond, the higher your exposure to movement in interest rates. So the higher the duration of the bond. So if you believe in our thesis that long-term interest rates are set to move higher here in the year to come, what you want to avoid, in fact, are longer duration bonds like a 50 or 100-year bond. So they're not really common in the marketplace. It's not an area of the market that we tend to focus on. Now, we tend to keep duration of portfolios in the kind of the 4 to 7 year range. We think that's the kind of the sweet spot for the bond market. So at the current time, again, our take is to be a little careful about the movement in interest rates on the long end of the curve and not take unnecessary interest rate risk.
Great, thank you. This one is from someone in the construction business, and what their question is I'm seeing incredible increases in material costs. I think we've heard about that, and associated commodities, steel, copper, and lumber in particular. Will this lead to higher rates of inflation?
Yeah, I'll jump in on that one, and then Jan, if you have anything to add, please do. But part of the reason for the increased costs is really part of what 2020 we had to deal with in the disruption in distribution channels and certainly economic shutdowns. So we have seen signs of inflation on a few different fronts, and it's part of our investment theme of overweighting and hedging inflation throughout the portfolios. So it's hard to argue that it won't, but I think it's a combination of many factors that could lead to higher inflation. And right now, it's also remains to be seen if, as those distribution channels open up, if we do see construction costs start to come back down to levels that we saw previously before the pandemic.
Yeah, I would just add, as we presented our predictions for 2021, now we didn't talk about inflation. We should have probably talked about inflation because it's one of the call that we've made in portfolios as well. We do expect inflation to pick up here in the next year or two. The Fed wants to see higher inflation. So, and as I mentioned, it's a way to also reduce the debt problem really that we have in our economy by boosting the nominal GDP of the economy. So we don't expect inflation to get out of control. We think the Federal Reserve and other central banks have the tools to control inflation over time, but we certainly expect to see more inflation in the coming years.
All right, great, thank you. Does the discussion around interest rates imply that mortgage rates will stay low?
Yeah, I think it does. I mean, the Fed's been very deliberate in the position they'll take. longer term rates are not necessarily controlled by the Fed, but they do have an influence on, and keeping that lower end low, in being in the record low mortgage rate market as we are today. We may see things creep up if economic conditions continue to improve, but ultimately remain, a lower, certainly from historical standard, than we have seen in the past.
And if you have a mortgage and you haven't refinanced your mortgage yet, you should probably think about that. I mean, rates are quite low, and you can save some money by refinancing. So a good environment really for everyone that has a mortgage.
All right, we're going to do one more question and let you guys get out of here, and our attendees get on with their day as well. You talked a little bit, Jan, about MMT and consequences that happen with that. Can you clarify that and maybe talk a little bit more about equity markets being in a bubble?
Yeah, so MMT is a difficult concept to understand, relatively new, obviously, concept as well. It stands again for modern monetary theory. The underlying thesis behind MMT is quite simple, though. It's the idea that government spending should not be dictated by deficit or the debt level of a country. And government spending is not necessarily irresponsible if it's meant to keep the economy going at full employment with reasonable inflation. So MMT says, go for it, government. If your economy is weak, don't waste a minute, go ahead and spend. And at the core of MMT, again, is the recognition that federal budgets are not like family budgets. So as sovereign governments cannot be forced into insolvency if they can print their own money. And that's where the central banks now play a role. So for MMT to work, you need two things. You need a government that is willing to spend. And two, you need a central bank that is willing to monetize or facilitate the financing of that federal debt at low rates. And right now we have both.
Great, thank you. Thank you for your time today, Randy and Jan, and answering all the questions. And I want to show my appreciation to our audience as well. This is our first webinar of 2021, and we hope to have more. We would love to see you in person at some time, hopefully have a mix of events throughout the year. But stay tuned. Please follow us again on LinkedIn or Facebook, and make sure that we have your correct email address so that you can stay in touch with us and we can stay in touch with you. Have a great afternoon. Thank you.